Thank you. Thank you, Dorcas and the team for having me. I'm grateful for this opportunity, being invited as a male speaker to this platform. I believe I'm going to share from my experience what I've learned also from clients and all that with the team. And we're going to make more better investment decisions that maybe where you have made a mistake in the past. So my name is Moses Njuguna Kimani. K stands for Kimani. I'm an investment professional for the last 8 years. I've been in the investment industry. My background, as Dorcas has explained, is that my background, I graduate in BCom Finance. I have a master's in science in finance and majored in the investment from the University of Nairobi. I'm also a member. The CC is it's an associate level in the Chartered Institute of Securities and Investment. For one to practice in the Kenyan market or in advisory, you are required by the Capital Market Authority to have the certification up to level 2. I'm at level 3, and I'm also a candidate in the Chartered Financial Analyst level 1. I'm also a CPA part 1, and looking forward to complete the rest. So thank you for this moment. I'm grateful, and I would like to give my colleague Zach to say hi to the team.
Hello everyone, my name is Zachary Maina. I'm also a private wealth advisor at Nabo Capital. We work together with Moses. Moses will take you through the presentation, but I'll also be able to answer on inquiries later. Any inquiries? Thank you.
Thank you, Zach. Allow me just to present. So today we are talking about investing with purpose, and allow me just to give a brief introduction to Nabo Capital. Nabo Capital is a fully owned subsidiary of the Centum Investment that has been in the market for more than 50 years. It started as ICDC and then came to be Centum, and now Nabo Capital is a subsidiary of that. We invest across Africa. We track over 900 securities across Africa through our investment strategy called quoted private equity. And then we manage about 16 billion in asset under management. We got the license to be the fund manager back in 2013. Started as a private arm of the Centum back 2007, but now 2013 we got the license as a fund manager. And also we also licensed by the RBA, Retirement Benefit Authority, to offer pension services, and mostly we do to the umbrella scheme. So we have different types, two main categories of client. These are institutional clients and individual clients. So we have sovereign wealth funds, endowment, foundation, insurance companies, as you can see, including the Nairobi Security Exchange is one of our clients, and including other insurance companies. And then individuals, we work with family offices, high net worth individuals, and individuals who are looking forward to start their investment journey. What do? We do three things. One, it is what we call asset management. This is mainly to the institutions whereby they are looking forward to manage their liquidity, grow their capital. So we help them by investing and making some extra money for them, and even managing the cash flow for them. So we also do what we call wealth management, like what you'll be doing today. This is part of the wealth management, whereby we sit with the client, listen to their needs, and evaluate the journey and try come up with an investment proposal and a plan, give you a strategy towards achieving your goal. So could be owning a home, could be financial dependence, could be even starting a business. So you are trying to build a capital. We can sit down and come up with an investment plan towards that goal, and you commit to that and you realize your goal in a given period of time. And then we also do investment advisory. This mainly involves big transactions. Let's say like a client comes and say, I want to invest across Africa, or I'm looking forward to an investment opportunity in a manufacturing oil company, maybe across Africa. We can transact such a deal and charge the fee for that matter. This is part of our board. Our chairman is Robert Bunyi and our MD is Scott Mushiri. If you visit our website, you'll be able to see this, and also this part of the team. And after this, I will request you go to our YouTube channel. We have a YouTube channel, Nabo Capital, whereby you learn a lot about the team, about what we have done before, and even the testimonials from our client. So let's get to the topic of today. And I'd like to start with 3 questions, actually 4 questions, and one of them, I'll ask that, how would you feel today if you woke up to go and pursue your passion without worrying about money, without worrying about your bills, without worrying about your financial needs, because you already figure out and you have an alternative way of financing it? How would you feel? The next question is, if you knew you had 5 years to live, what would you do differently today? And if you knew you had 12 months to live, what would you do different from today? And if you had less than 12 months to live, how would you do things different? How will you manage your money? Yeah, spending your money and all that. So I will go to the normal journey. When you are born, the journey, what we call income versus age graph. On this side, on the lower side, we have the age as you grow old from let's say year 25. When you are below year 25 years, we say you are dependent. You are depending on your parents, on your guardian to be able to be financed. After year 25, we are assuming by this time you have gotten a profession or you are in a career, you are able to generate an income, and we call this accumulation phase. An accumulation phase here, it is what we say you are building for your tomorrow. Yeah, in this phase is very critical because the decision that you make here, they will have an impact on the second phase that you start from between year 55 to 60 at the retirement. When you get at the retirement, the next phase from that point is spending. And we all know that retirement is real, and the retirement will come at some point. So either if you take maybe the number of years remaining, I know all of us, we have different in terms of when are we approaching the retirement, but it's real, it's somewhere, yeah? And even those who work with the government on your payslip, you can even see the number of days remaining towards your retirement. So it's coming at some point. So we are saying you need to be prepared between retirement age spending, and then if you go beyond 70 years, it's dependent at that point. And we are saying, in this part of on the right side where you see this arrow, this dotted line, this will depend, the lifestyle that you live on this side will depend on what are you doing here. The mistakes that you have done mainly on the money will be reflected here with the kind of lifestyle that you have. Yeah, when you make wise decisions on your money, it will reflect on your investment journey here, your lifestyle here after retirement. So let's evaluate and see. The purpose of this session is to gauge where you are, to see how you are doing, and also to learn. So we are not saying this is how you're gonna do, but it's just more to guide you and also to address where you may need a guidance. So we go to the next level where we'll talk about active versus passive income. And what I've just said before is that if today you woke up and you realize and you have figured out you have an income coming, all your needs are taken care of. You don't have to work just to look for money. So you're working because you're passionate about what you're doing. And we are saying this is the active part of it. If today, and I know most of us, we can't take that mistake and you say, my passion is maybe in design, or my passion is just maybe doing something different. It may not earn me money, but I want to pursue that. But deep down, you know, if you dare and say, this is what I want to pursue, you know very well, you'll not have a source of income. And this is now what we call the left side of this presentation. It's active where you work for money. You can't sacrifice, you can't forego, you can't do something else because you are needed. And first category is when you're employed, where this part, you exchange your time, your effort for an income. You don't work, you don't get paid. You don't go to work today, there is no income. And I know I'm dealing with the right team here that determines our predicament at the end of the day, maybe, or what you're gonna get at the end of the month if you're not being committed. The HR team is always on our case, so I know I'm dealing with the right people. So the other category I would address is what you call self-employed. Self-employed, yes, you are not working for someone, you're working for yourself, but can you take a break? Yeah, you work for yourself, but you can't take even a 6-week holiday and your business keep on going without you. You have to be there. So if today you fell sick, that means your business will not work. If you're in consultancy and today you didn't manage to go to work, it means you don't have systems that outlast you, that can outlive you, or even you can take a break and then everything will continue and you get paid. So at this point, we say on this side, left side, you are an active income earner. And what that means, your time, your talent, your skills are needed for you to be there. Then on the other side, we have what we call passive income. And passive income here, we say money is working for you. Even when you're sleeping, there's money somewhere that is working for you. There is a return being generated. There is a compounding effect on your wealth. And this is what most of the rich people do. Yeah, on this part, whereby you either have a big business. Let's see someone like let's say Jeff Bezos, or we have Zuckerberg has a Facebook and all that. Yeah, and other, like let's say Alphabet, the owner, the shareholders and all that. They don't have to go to work to earn, or even let's say Safaricom, the shareholders. Yeah, the company they have hired, they have put systems into place. People are working hard for them. They're generating an income, and at the end of the day, they are getting paid, and the interest as the shareholders are protected. So we say this is the differentiator. One side you are an active income earner, the other side you are becoming a passive income earner. Then we have another category, an investor, and we are saying they are the people that have money working hard for them. They play golf. They live a good life. Yeah, in the morning you see someone going to play golf. You are trying to beat traffic to get to the office and work. And I'm not saying working is bad, but what I'm trying to say is you're working today, but this should be a source of your capital. Your income that you get paid or your salary is a source of your capital towards building either a business or becoming an investor. And you need to work in terms of you transition from active income earner to a passive income earner. And that's when you realize the difference. And when you realize that your passive income is more than the active income, at that point, that's when we say, for sure, you are heading to the financial freedom. You're already there, or you are on that path. When you have investment that are generating interest for you, how do you transition from active earner to the passive income earner? It is what we're going to discuss tonight, and we try to evaluate ways how you can do that. So on the active income, you spend your time, you get paid. You have expenses, but as you have the expenses, you need to set aside, we say 30%. 30% of your money should be set aside. The government takes 30% in terms of tax. You should pay yourself. And I'll talk about this in the next slide about how do you budget to pay yourself. You should pay yourself through savings and investment. And this investment you are making, this is what will help you transition from active income to a passive income, whereby in passive income, you have investment that are being managed by investment professionals that are working for you. Either you are getting a returns or you're getting capital appreciation, and then you're getting a return in from those assets, and you can spend from the return you're making. But here, if you go the other way, you spend 100%, you'll be spending your seed capital towards creating passive income. So what you're saying is you need to have a discipline and separate between active income, what you are getting from the expenses, and what you are setting aside for you tomorrow. This is your seed. Savings, it is your seed to help you close this side. So when we say someone is a high net worth, what do we mean? And I've just mentioned something that you need to pay yourself. how do you pay yourself? At the end of the month, you've gotten your income. Let's say you only have one stream of income, which is the active income, your salary. You don't have any other passive income. When you receive that money, it will depend on your priorities. Either you're religious, you pay your tithe, philanthropy activities, and all that. That portion goes there. The next person we say, you need to pay yourself. You matter a lot. And we say you pay yourself through savings and investment. This could include these assets here. Either you set money to buy bonds, you have some insurance policy, you have some property, you are investing towards portfolio. Yeah, like what I'll teach you about various portfolio that you can build to caution you even towards your retirement. So you can be setting aside some, maybe, or like what I've said, 30%, minimum of 30% of your income. Yes, you have obligations, and obligations are with the families and all that will keep on increasing, but you ought to pay yourself. You are paying others. Yeah. And what happened, the scenario that you have been seeing, we are so generous in paying others. When you receive your money, you start pay rent or pay your mortgage or pay the other things that maybe even pay Safaricom. You bought airtime today or Airtel or whatever. That is paying others. We are so generous in paying others and we forget ourselves. And we are the people who do the work. So first of all, in your budget, have what we call pay yourself through savings and investment. Then the next thing, now you can pay others. Whatever has remained, now you can apportion from your household, from your transport, from your fuel, from your airtime, transport, your house manager, you go all the way and provide for miscellaneous. And then divide your expenses. We say divide your expenses into two: fixed expenses and discretionary expenses. When you're paying others, let the fixed expenses that you know every month, for me to have a good life, or for me to be able to work and to operate well in Nairobi or wherever I'm located, I need 100,000. This 100,000 goes where? My house rent or this obligation. So I need 70,000 or 150. That is a fixed income. And you need to watch that, because there is it's human behavior. In behavioral finance, there is a tendency of increasing our expenses anytime we even hear a salary increment, or even anytime that we have a salary coming. That is time you start moving where you stay, you realize you don't have a good security, you go to neighborhood that you feel now there's a tangible security, and you start changing things and all that, changing your furniture, importing and all that, but you have not paid yourself. This is paying others. So what you are saying is, plan, have a fixed income, fixed expenses, and you know in a month this is my fixed expenses. Then in case you want to upgrade or something that you want to change, have it in what you call discretionary expenses. It doesn't occur every month, but you say, I want to do maybe upgrade my TV set, maybe I want to buy a bigger screen and all that. And you say, I need this money, but I can put aside in maybe in a money market fund, contribute 20,000, or have what we call sinking fund. A sinking fund, it is where you're putting some money even for your insurance. You know, at the end of the day, the year, you renew your car insurance. You can be setting aside setting some money in a sinking fund. It can even be a money market fund where it's earning some interest. And one thing I'll also caution, in my presentation, I've said, you should not just save and keep the money in the bank. The money should be kept in an investment vehicle whereby it's earning a return. Why? Because the money loses value to inflation. And what is an inflation? Inflation is just a consistent increase in prices of things. The way you used to buy a loaf of bread maybe 5 years ago, it is almost double. Or let's say 10 years ago, it's almost double right now. What has happened? Same grams, but the prices have gone higher. So you need to invest your money where it's also growing. So come to what we call, after you do your budget, and now you are investing, you come to do what you call net worth analysis. Or how do you plan your net worth? You need to have assets. And assets, we just say simply, these are items that are put money to your pocket. Anything that puts back money to your pocket, we refer that as an asset. And there are different categories: current asset and long-term assets, or short-term and long-term. So you have maybe the cash, what you call cash and equivalent. These are things like money market. You have investment portfolios. You have bonds, property that are giving you returns. And then you come to what we call, then you do total of your household. To know how much you're worth, do all that. You have a plot somewhere you bought, how much is it? You have a house, a rental building that you have gives you a rental income, put it there. You have, maybe you have done something, you have wrote a book that is giving you a patent, or you have maybe a YouTube channel that is giving you an income, put it somewhere. That is part of your assets that are giving you money. Then come to what we call we come to what we call liabilities. These are things that are taking money from your pocket. You have a circle loan, you have a mortgage, you have a bank loan. And what I want to say is that debt is good and debt is bad. If the debt is taken to invest, whereby you are getting returns for your money, then you refer that one as a good debt. If it's taken for consumption, whereby you go back to your pocket to pay the principal plus the interest, then that's a bad debt. Simple. There are those that you try and check. And people will ask, is my car an asset or a liability? If it's a tool that is helping you to generate an income, then that falls under asset. If it's just a car that you bought, put it in the park, just keep it in the parking. You don't need it once in a while and all that. It is not like a necessity. So then at that point, the way you financed and how you did it, then you need to see, is it depreciating or appreciating? And is it a liability? So you need to judge to do that. So when you take all your assets, less the liabilities that you have, you realize on what path are you? Are you on net worth negative? Are you on positive? And the goal here is to move you from negative to the positive side. So I'll move fast because we have like we'll do 40-minute presentation and then we have like 20 minutes for Q&A. So we go to what we call a Maslow hierarchy of needs. We have interacted with this in one way or the other, and we say that human needs, they change every day. And you start from what we call physiological needs. In this category, you're talking of things like food, shelter, clothing. That's the basic needs. And then you go to safety needs. Safety needs, you care about your securities, your health, your property. And then from there, you move to, you want to be loved and belong. You want to belong to this family, class of the friend, sense of connection. Then from there, you care about your self-esteem. How do people recognize me in the society? Who am I in the society? It comes that. Then you have at the top what we call self-actualization. You become the most that one can be. Yeah. But this journey, sometimes if you look around, maybe in the morning when you're in town, you'll see people sleeping in bags and some under these buildings on the floor, and it's raining. Someone has even a kid out there at the street, and you ask yourself, are they not concerned about your safety? But they don't even care about safety because they have got it wrong in terms of physiological needs. They don't have the basic. And sometimes what differentiates us from them, it is because we have an income. But when we come and check, if today the income is taken away, you'll find yourself also, I don't want to say on the street, but you find yourself having or suffering or having some problems, cash flow problems. And then you're earning well, and then this time the stream of income is not there, then you find yourself, you are suffering. So what we say is that as you move on in life, you need to build portfolios that will take care of you. Yeah. And from this point, this is where we sit down with our client and build what we call wealth management, whereby we listen to you, come up with investment portfolios that will address your needs. And in this category, we have come up with 4 portfolios that we say these 4 portfolios will address your journey, as what I have just shown you here. So we'll have these 4 portfolios. And this is the most important point I'd like to talk today, that as you invest, connect your investment with a goal, what we call goal-based investing. You're not just investing. Sometimes you meet someone and say, you ask them, what is your journey in the investment? Some tell you, I think I did a money market some time back. I think I lost. I think I don't like it. I give up about investment. Then you ask themselves, did you have a goal that you are looking for to achieve? They say, no, just a friend of mine saying it's good you keep some money aside or have is I lost, or I tried this investment or this company, they went with my money. So that person becomes discouraged along the way. So when we talk of the goal-based investing, we want you to connect your investment with a goal, a specific goal. And the first goal I'll talk about, or one of the needs in your life that you need to take care of, is what we call lifestyle portfolio. I've given a scenario whereby if today you lose your income, will you still drive the car? Will you still live in the same neighborhood? Will you still have the same lifestyle, or things will change the next day? Or your landlord will be the first person to know that this month I'm going to be late because I lost a job. So how can we cure that? The first portfolio that you tell a client that you need to start building, and this is not an emergency. I'll talk about emergency fund. This is a lifestyle portfolio. In a lifestyle portfolio, as I said, the income, the salary you are paid is a seed, or is a seed capital towards winning you off from active income to passive income. So once you start getting paid, and you tell people the first day you receive your, you get paid, that the first day you should set aside money. You should put this money in a vehicle, something, let's say 30% of your income. Yeah, 30% should be invested in a vehicle whereby you are able to earn a return. So you build this portfolio of a given period of time. Yeah, you build this portfolio of a given period of time, and it will come now at the point to take care of you. It could be 5 years, 10 years, or 20 years. Yeah, bit by bit, you are building up a portfolio, and the goal is to replace the active income. So there's what you call active, we call it income replacement strategy. That yes, today I'm paid 200,000, but can I build a portfolio that one day my assets are able to give me 200,000 without me going to work? That is what we call a income replacement strategy. And what will enable you to do that is a lifestyle portfolio. So you need to have a lifestyle portfolio, and you need to build it from today, or even, yeah, let's say from today, you need to start building this kind of a portfolio. Then we move to the next level, which we call it security portfolio. Security portfolio, and the lifestyle portfolio should take care of things like food, clothing, shelter, and all that, those basic needs that you have. Then you move to security portfolio. Security portfolio, even from Maslow hierarchy of needs, I've shown you that you move from the physiological needs to security. Now here, things like the health of your family members. You need to cover them, no matter how hard you are working towards creating wealth. Yeah, a medical bill has become so expensive. Maybe your loved ones, could be your parents, could be your father, yeah, or your mom, and maybe they're in the village or they're somewhere, they're not able to protect themselves. But in case they fell sick today, despite you having a portfolio at Nabo, which you have said is a lifestyle portfolio, the following day you call Moses and say, I would like to liquidate my money. I would like to liquidate my 1 million and take care of my parents. So what you're saying, it's a simple, take care of them, even your family members, yourself, take care of that, because that can disrupt your journey towards wealth creation. Education is another thing that you're equipping your education, your children, and all that. Plan that. Have an investment portfolio that can address that. You know, if I want my child to go to this university or this college, I've done my maths and I know I can start now. And this goes to those who already have the children in school, those who are yet to have kids and all that. You can build a portfolio to address that. Then home ownership. You may not have a privilege of getting a mortgage at a better rate, and you try to figure out, and you're like, how do I go about financing my home? You can build a portfolio towards this goal. And when I say this, I'm very passionate about it, because I met this client of mine who, he was in a bank here in Kenya, I don't want to mention which, they had a bit of had some deposit there. And at some point they approached him and told him, you know what, Mr. So-and-so, you have this money, you can take a mortgage. Your goal is what? He said he had around 8 million, and he wanted to build a home. And they told him, we can extend you a mortgage, yeah, with this money, and then you can pay this mortgage within almost 18 years and all that. And then he looked the interest and all that. Then that time he came to us and I told him, What about we check an alternative? Yeah, an alternative way of building a portfolio towards owning a home and invest what you already have, and what would have been going towards the repayment of this mortgage, you make it as a top up to this investment. And we did the months and all that, and we realized within 4.5 years, we already have a portfolio. And right now we are in the third year. In the third year means by next year, let's say by next year, January, we'll be able to buy, my client will be able to buy, to build the house that he wanted, the budget. And you start just withdraw, do the milestone, come for some part of the portfolio. And after that, we continue, convert this portfolio to another goal. So this is what we call security portfolio. You can have alternative of building this emergency fund. You can open even a money market fund and you say, my goal is to cover myself for the next 9 months. If for 9 months, I'm not 6 to 9 months, I don't have an income, what is this that can take care of me? Then you can say, I'll be putting this amount of money. And then now we go to what we call aspirational portfolio. Aspirational portfolio here, we talk about your bucket list. These are the things that you're looking forward to own. You want this car, you want this a holiday home, you want this to go travel to this destination, but you know very well you can't do it right now because you have a lot of obligations, but you can plan it. And we are having a problem, what we call low and middle class and all that, whereby the kind of the lifestyle that people are portraying out there, looks like aspirational portfolio. But in case of anything, they lose their income, they become worse off because they go the negative side, because you find these assets were financed through credit, the houses, the whatever, everything. And the good the time to reflect on this was the time of COVID, when some people lost their income. The bank was busy repossessing their assets, the houses, the cars, and all that. And you realize people relocating from one location to the other. Why? Because they're not figured out the lifestyle portfolio. They're not figured out the security portfolio. They were here for the lifestyle. They want to live the best and all that. I have an income, my job is paying, but no one ever thought one day we can have this scenario that jobs are closing, hotels are closing, and all that. Then move to what we call a legacy portfolio. Legacy portfolio here, we are saying you've worked for the next 30 years or 35 years. Whatever you are building, how is it going to benefit the next of kin? Could be your children. A multi-generation wealth transfer. We have seen families fighting, taking each other to court because the founder or the vision, the one with a vision, left a business. They are not able to learn the business. They are not able to understand each other. They take each other to court, try to share the money. And to avoid this, sometimes you could be having a business that you're running, but your kids don't have even any passion in that. So you're saying, I'll have this business, they run when I'm not there. They may not have any interest in that business. They have a different passions, things they want to pursue. So what do we tell our client? You can build a portfolio that can address this need. You can build a portfolio with an investment professional, because what your children will care about is cash flow. Whatever is giving them cash flow. They will not be concerned you had some plots in Mlolongo, you had a plot in Katani or somewhere in Juja farm, all those things, or somewhere in the other part of the country, whatever you bought the land and all that. They may not be concerned. Them, they'll be concerned with the cash flow. So if you left an investment that is giving them a cash flow, they'll be happy. And when I say this, we had a case of during the COVID. Unfortunately, we lost a few clients through COVID, and one of them was a single mom who had the son and the daughter. The daughter had started working, and the son was in campus. So she lost, she passed on. That was in 2020, and the process we follow, there is always the beneficiaries on the investment who should get this and all that. We followed through the legal process and all that, and the children were the beneficiaries, the son and the daughter, and they came. We sat here and we spoke, and they said, we want our money. The mom used to get around 150,000 monthly, and they said, we want whatever the mom left for us that was invested at Nabo. And we sat down and asked them, what's the plan do you have for this money? And they said, no, we just want the money and all that. And then we told them, what about you give us just a month? to manage this investment as we continue sharing what your mom was doing with this. And we spoke with them and we told them, your mom was receiving a passive income of 150,000 while the assets are secure and they are managed here. What about you give us an opportunity to continue managing this, and every month you're getting 75,000, you're getting 75,000. And then the son is in school, so paying school fees and all that. So we did the plans, and after 3 months, the daughter came and said, for sure, I've been getting my returns. So what I want, can you be reinvesting back the returns? Because I'm already working and I don't think I need this liquidity, the money I'm getting every month. My brother continued sending him because of the school fees and the upkeep and all that. And after that, the son completed, and we continue managing this portfolio. But what would have happened if there was no this plan, or there was no an investment professional that was guiding? The first thing is sell liquidate the money, have the money in the account, buy cars, and do all those things that they needed. So that would be the scenario. And at the end of the day, they will not have had any money up to now. So we are saying invest with the purpose, work with a professional, start building this portfolio. So from the presentation, the most important part I want you to know is these portfolios. You need these portfolios to build them. Yeah. So how do you go now allocating your money to different investment, or what are the factors that will guide you in terms of your investment? And one of them is how much risk can you accept of uncertainty, and how much can you accept of uncertainty and risk? Investment risk, you cannot eliminate risk, but you can manage risk. You can reduce risk. And what is a risk? We say risk is the likelihood of not realizing the target or the desired results. So we say an investment, what's an investment? We say it's a commitment of your financial resources to an asset with an expectation of given returns at a given period of time, over a given period of time, and a certain level of risk. So time, return, and risk, they must feature on any investment you do. So anyone approaching you and telling you, you can double your money, always ask, how much can I also lose? Can I lose all of it? If I can double my money, what are the chances of me losing the money? The risk aspect. And then how long? Wealth creation is a journey. Wealth creation is proven as an art of stewardship than just making money every day. It's a journey that people walk through. It's not an event that you wake up today and you realize I'm rich. It's a journey, and if you do the research, you'll see how billionaires and all that, they have done the journey. Maybe could have taken someone 30 years, 20 years, 15 years, yeah? So take care of the risk, yeah? And we have two types of risk. One of them, we call it systematic risk. Systematic risk is a risk that you can't remove that risk, yeah? You can't diversify. Let's say like the time of COVID, anyone in every sector, if you're in transport, you are in banking, you are whatever, everyone felt the risk that was there. But there's what we call unsystematic risk. Unsystematic risk is a risk that you can diversify by simply not holding all your assets in one basket. Simply that you have maybe a real estate product, your real estate property, you have a money market, or you have a fixed income fund there, or a fixed income asset, and you have some other assets that you are doing, such that if one loses, you have some stocks. If in stocks are not doing well, you have another investment that is giving you return to offset the loss you're making on the other side. Then how long do you plan to invest your money? Time is an aspect. Consider your individual situation. How much financial responsibility do you have for the future? How much have you started earning right now? Consider even the dependents. How many the kids, maybe you're supporting a parent and all that, and you're doing all those things. How much is this that you can set aside to invest? Yeah, so these are some of the factors you need to consider. And then we have what you call importance of asset allocation. When you do asset allocation, it guides you in terms of having a balanced portfolio risk tolerance and the length of time. Yeah, you reduce risk through diversification. What I've said, you're not holding all your assets in one basket, or your eggs in one basket, and then you realign and adjust based on changing needs. When you're young, there are some risks you can take. When you're, let's say 45, 50, their risk level you can take. When you're 50 to 60, their risk you'll avoid. Why? You don't have luxury of time. If you lose the seed capital or you lose your money, you don't have time to recover. So we have different investment, and let's consider stocks as one of our part of the risk assets that we have, because the market keep on changing and your capital is not preserved in stocks and all that, but you can double and triple. It's a growth stock. So you can buy, and why do you buy stocks? You buy stocks for two purposes, for dividends and also for what you call capital appreciation. Those people bought Safaricom at the IPO, maybe at 5 shillings. Currently, they can sell at over 20, 30, there was a time it hit 44. There's that capital appreciation and the dividends that are paid over time. And you can choose stocks in terms of value stocks. Let's say something like BAT, that's a value stock, EABL and all that. If you're choosing something like you're looking for a company has a lot of potential to grow, you buy into that company is what we call growth stock. So you can take 100 minus your age and know what percentage of stock you can hold. This will tell you, one, an investor A. Let's say an investor A who is 22 years old. This person has 40 years to retirement. This person has a high risk tolerance. High risk tolerance in this, they can lose the money and recover. And sometimes we say, I am a risk taker, but are you a risk? Do you have a risk capacity? Because you can't take the risk today, but you don't have a capacity of risk. And how do you gauge your risk capacity? If you lose that money that you're investing today, will you still be comfortable? Will you still operate and feel like you have a good life, even if you lost that money yesterday? So you assess that and you realize, for sure, this is only that I have. So your risk capacity is lower, then you have a lower risk tolerance. Then we say, this investor is interested in growing their retirement savings over the next 40 years. Their retirement investment portfolio can look like this. You can have 70% in stocks. You can have 25% in fixed income assets. And you can have 5% in cash and equivalents, money market and all that. Then investor B, who is 40 years, has 15 years to retirement. This person has a moderate risk. Yes, you can accept some risk, but not as much. So you say this investor has more than a decade to go until retirement, but less time to recoup any major market losses. They are willing to take on some risk to keep their money growing, but don't have a luxury of multiple decades to replace any money they might lose between now and retirement. They want a diversified portfolio that will offer modest upside, but still protect them from major market downturns. And this is how their portfolio look like. They can have 40% in stocks, 50% in fixed income assets, and have 10% in cash. As you grow older, you realize cash is very important. Cash flow is the only thing that you'll need, medical and all that. So as you're getting 60 years, beginning of retirement now, you have a low risk tolerance. The investor is celebrating end of their working years and they are looking forward to using their retirement savings to explore new horizons. So this is not the time to start business that you don't have an idea. You got the money for retirement, you are putting this money into matatu business, then you are called, you are told your matatu has been taken to a police station early in the morning and all that. And then maybe you have an issue of, because of the age also, at this point, you can't handle more pressure and it will kill you. Some of the investment you do at this point will kill you when you see your long time, your lifetime savings coming to an end or losing all that money. So you don't have the options, yeah? And then we are saying you want to a diversified portfolio that help preserve your capital. Capital preservation is a key. Well, you offer them selected opportunities for upside growth, small growth, but you're not losing all your money. You're not taking a lot of risk. And this is how your portfolio can look like: 20% in stocks, 60% in fixed income assets. These are bonds, fixed income asset, fixed income. You have some rental, which are giving you income, and all that. And you are very sure that every month I can get this income coming. And then you have 20%. Here, you have 20% in cash. In case of need, in case I fell sick, in case of being, I have this cash that I can take care of me. Yeah? Then, now, what are the options or opportunities that are there for someone who is asking, how do I start investing? I've not invested yet, but where do I start the journey? And one, I will introduce what we call unit trust. And a unit trust, we say, why invest in a unit trust? This can include things like stocks or shares, securities independently. You can go there, buy those stocks and all that, bonds and all that. But Capital Market Authority has given fund managers, has given license, have come into the market to regulate what are happening in the market. And so Capital Market Authority comes to regulate the market and ensure there is an integrity of the capital market and the sanity, that people are not coming up with their things and taking people's money. So there are different categories. If you go to this Capital Market Authority, you'll see different companies or different categories of the license. We have the stock broker, we have NSE, we have the derivatives brokers, we have fund managers, we have advisors, and you'll see the list of that, and you see Nabo Capital there and other fund managers that are there, and also what we call collective investment schemes. All the funds that are offered by the fund managers, they are also regulated by the Capital Market Authority. So one, why you require this? One, you have a professional fund management. These funds, they are managed by investment experts. That's what we do every day. We earn a fee from managing a portfolio and the growth in your portfolio. Two, there is a diversification whereby we invest in different assets, yeah, to ensure that we cover you. You're not worried which investment do you buy, which one. Like now, there's a bond coming that's already in the market. We are going to buy that in our fixed income fund. We are going, if you need a stock and all that, that's what we do. You should not be worried that we are just reporting to you at the end of the month the returns and the portfolio allocation that we have done. Then there is a choice. There are various unit trusts that you can choose from in the market, easy access to convert your money into cash. Yeah, you people, and what we've been experiencing, people are rich in their asset rich, but poor cash when you check on the cash flow. People have plots and someone comes and tells you, how can I liquidate my plot somewhere interior there and get it into cash and be able to meet this need? And sometimes we tell them it will take time. Unfortunately, we don't deal with that. There are people who come, maybe they are older, and they say, are you able to sell my land somewhere and invest this and be giving me monthly income? But unfortunately, we are not able to do that. I'm not saying land is bad, but what I'm saying, in your portfolio allocation, you need to diversify. You need to balance what is in the properties, what is in the assets, the fixed income assets, and what is in the cash. You need to balance that. And then easy access of your money, you can convert it into cash. Then flexibility, you can move around to other funds. And then you got cost-effective, simple and effective way of investing small amount of money. You don't have to have millions. You don't have to have big money to start investing. You can start from as low as 10,000 and commit a goal and say, I'll be building my portfolio from 100,000. And my colleague, Zach, will do kind of a proposal that you do with a client, a plan, and show you how you can build your portfolio. He'll illustrate that. Then you have disciplined investing. You know, every month I have a portfolio, and I know I have maybe attendants who are in this group who are also clients here or clients somewhere else, where they make monthly contributions towards their investment. So you are disciplined in terms of investing, and then you get a higher returns. Anything that you're investing in should always over and above inflation. And I explained what's an inflation. That is a consistent increase of prices of gold over a given period of time. Whatever you're buying is not changing in quantity, but the price of that thing is going higher. And there are two different types of inflation. You have what we call cost push inflation and demand push inflation. Demand push inflation occurs when there is a lot of money in the market chasing few goods, hence the suppliers and the people with the goods, they keep on increasing their prices. You find that today you went to buy a loaf of bread because only few companies that are doing that, or bakery that are doing that, the prices you go for, you find the loaf of bread is at 1,000. It can happen in a demand push inflation where there's a lot of money. And that's why the CBK, through what we call monetary policy committee, they sit down and say, what is the rate? What is the inflation how can we counter this inflation? So then we have what we call cost push inflation, what we're experiencing currently. Cost of things going higher. From the droughts, from the dollar, the depreciation of the Kenya shillings against the dollar, making imports very expensive, and things, and oil prices, the world market, the oil globally, the oil prices going higher. We have a lot of sectors that are driven through this, and you find the prices of things, the final products becoming higher. So you also need to invest your money in assets that are offering you higher returns to counter this inflation. Yeah. So let me touch on regulatory framework of unit trust, or these investments that are there. And on this side, we have investor A, investor B coming to invest. Yeah? So they come with their money, and they come, let's say, a Nabo Capital as a fund manager and also administrator. And then you invest your money. Our role as a fund manager is to look for investment opportunities. And CMA has established the parties that are involved in this. At the top here, you have the CMA, which is watching the market, how you are doing. So you have one. The CMA says you need to have a trustee, you need to have a custodian, and you have an auditor. And what are the roles of these people? These people are appointed by the CMA. We don't approach any bank and tell them, can you be our trustee? Can you be a custodian? We go to the list given by the Capital Market Authority and check which one bank that we want to use it as a custodian and the trustee. And what is the role of the trustee? The trustee acts as a supervisor to the fund managers. And in legal terms, we say trustee is the legal owner of the assets under management. So these assets that are being invested, the money clients are putting here in the custodian, that the legal owner is a trustee. And in case of any problem, or there's any let's say Nabo does not deliver as a fund manager, it is a trustee who initiates the process and even reporting the same to the Capital Market Authority. And every month as a fund manager, you report to the Capital Market Authority. And then you have a custodian. We are not fund managers are not deposit-taking institutions. If you walk to our office with cash, we tell you, no, we don't accept cash, we don't take deposit and all that. So what happened? We direct you to our custodian bank, whereby we have a custody account. You go deposit the funds in the custody, and then we get notified that client so-and-so has invested this money, then in this fund, let's say money market or fixed income or another fund. And then now we tell the custodian, buy us this bond, which has been issued through the CBK. Buy us this money. So they move, and when they move, we get what you call bond certificate or security document, which moves also to the custodian, and we also have a copy of that. So, and then you have an independent auditor who audits our financials. And in case they realize any material breach, yeah, in case they realize any material breach, they report directly to the Capital Market Authority. And that's the same with the custodian, the trustee. So the CMA, it is there to protect investors. All levels of investors, from low income earners, those who are high, those who are ultra high net worth individuals who are investing in the regulated market space, they are there to be protected by the CMA. So that's a regulatory framework. For further discussion, you will engage us. So then we have a comparison in terms of risk. So we have money market fund. What are the features of a money market fund when you hear a money market fund? Money market fund is a basic investment account you can have. And money market fund offers you liquidity. You can access your money within 24 to 48 hours. A money market fund gives you the lowest risk possible. Where does it invest? In treasury bills, in commercial papers, and also in bank deposit, regulated market space. So in terms of risk, has a lower risk. It doesn't invest in shares and invest in treasury bills, bonds, and all that. There is no initial fee, there is no redemption. Management fee for fund managers, we are allowed to charge up to 2.5%. As Nabo, we charge 2%. We recommend money market fund for someone who has an investment horizon of 3 months and below. If you're looking for 6 months and above, 1 year, or you want to build a portfolio like what my colleague will explain, let's say a home ownership or an investment plan to give you a passive income that every month, my retirement, I want to have 200,000. If you're looking to build that, you can use what you call fixed income fund. Fixed income fund mainly invest in the corporate bonds and treasury bonds, the either infrastructure or FXD bonds. So, and also you have a bit of bank deposits. So you can see the risk is still a low risk. There's no shares, there's a bonds, 100% it's in bonds. There is no initial fee. there is a redemption fee. These funds locks the fund into the first 6 months because of the nature of the asset we are buying the bond. So the first 6 month initial capital is locked. But in case you want to withdraw, you'll incur what you call 0.25% redemption fee on the interest. Both the money market fund and fixed income fund, they protect your capital. And then we recommend 1 year, and then we move to equities. Maybe you say, I don't want to go buy stocks. You can invest in our equity fund. One, it has a higher risk. Yeah, it invests 100% in stocks, doesn't invest in bonds. These are the features. And then we have a balanced fund. Balanced fund is whereby you can have a 50% in stocks and 50% in bonds. So you can balance that portfolio. So that is the presentation on different investment. And at this point, someone is asking, how can I build a retirement portfolio? Or how can I build a home ownership portfolio or an investment plan that I can be contributing and see growth? And this time, I'd like to give it to my colleague, Zach, just to illustrate an investment proposal or an investment plan that we do, and also handle Q&A. Then we'll engage. Thank you. Zach, you can take over. Yes.
Thank you, Moses. So I want to illustrate how you can build a portfolio. This is just a scenario. These plans, we normally customize them depending on the client's needs. So I'm going to assume someone who has an initial investment of 100K and they're able to do a monthly top up of 50K. We are going to put them in a low risk investment. For this one, we have recommended fixed income fund. The returns range between 11 and 12%, as Moses has illustrated. So in this plan, we have assumed the target is to achieve a return of at least 11.5 net of management fees. Okay. So assume someone is building a portfolio towards maybe home ownership or even a lifestyle portfolio that can give you a passive income at the end of the investment cycle. So in this model, we have shown you how you can build a portfolio within 5 years, 10 years, and 15 years, 20 years. So if you're doing 100K as an initial investment and doing 50K as monthly top up, within 5 years, you'd have built your portfolio to 3.9. Okay. So for instance, you are doing this portfolio towards home ownership. You don't want to take a mortgage that is going to take you 15 years or up to 20 years to have a home, maybe a mortgage of 10 million. You want to be patient and build a portfolio that can give you a home within 10 years. So within 10 years, you can see from this that you can achieve a portfolio of 10.1. Okay. If you still have more time, you can continue building your portfolio for 15 years, which will grow up to 19.9. This is the sum of the contributions plus the return, the net return after tax. So if you'd continue building this portfolio for 20 years, you'd see that your portfolio would grow to 35, one who is doing 50K every month. So the assumption here is that the net return net of associated fees is 11.5. After tax, it becomes 9.78. We were assuming that you start your investment cycle in March 2023. So I want to show you how now this portfolio can give you a passive income. So if you are building a portfolio for 5 years, you build a portfolio and then it gets to 3.9 in 5 years. 3.9 can give you a passive income of around 30,000 every month. Okay. If you build a portfolio for 10 years, the same scenario, doing 50K every month, you'd build a portfolio up to 10.1 in 10 years, which is giving you a passive income of 79,000 Kenya shilling. In the Kenya market, if you maybe want to own an apartment, maybe a one bedroom would range between 7 and 10 million. And such an apartment would give you a rental income maybe of 6%. 6% is around 40,000. So you can see from this, an investment portfolio would give you almost double or more than double of what an apartment would give you. So you can see why it's important to build a portfolio that can give you a passive income. So if you're able to do this for 15 years to 19.9, it would give you a passive income of 155. If you're able to build it to 20 years, it would give you a passive income of 277. So you can see from this, the earlier you start, the better. Actually, as Moses was saying, it's good to start building your portfolio or your lifestyle portfolio from your first paycheck, because you can see, if, for example, you started working at the age of 25 to 30 years, for example, if you are able to do 50,000 every month from the age of 30 years, you'd within 20 years, when you are getting to 50, just doing a monthly top up of 50,000, you'll be able to grow your portfolio to 35.6 and be able to have a passive income of 277. So this 277 is what that 5.6 is giving you, and then you're preserving the 35.6 is going to pay you for the rest of your life. So when you retire, for instance, you'll still continue earning this income without depleting your portfolio. Okay, that's all for how we can grow the portfolio. But you can always reach out to us if you want to have a personalized plan. Yeah. So we can go to the QA session. If you have any question, please reach out. You can chat.
Yeah, we already have questions here, and I think we can answer them. Yeah. Just the first person is asking, what portfolio would work for Muslims who cannot earn and consume interest? I think there's Muslims in terms of what do you call this? The funds that are compliant to the Sharia product, and most involves sharing of profit. And sometimes the real estate based like funds and all that you're able to share profit and all that, they can work. But I think for this case, it is good. Barala, we sit down and come see us. We can guide you. If we don't have it, we always have people that we can work with. So we can always direct you to someone who can do that. So then, when it comes to a loan payment, is it advisable to pay lump sum if you get money from other sources first, then the repayment, the loan is on a reducing balance? Mercy, that's a good question. So one is the interest that you are paying this loan, and what was the purpose of this loan? If you invested this loan in an investment that is giving you the return, the other money you better invest. If the return where you invest this money, you are able to service this loan. And I said, debt is not bad. There's a good debt and bad debt. If the money is invested in an asset that is giving you the return and you're able to offset, then you can let this investment continue. And at the same time, invest the money that you have, the lump sum amount, in an investment vehicle, which will give you even a higher return than what you are paying towards the loan. Because I say, even if you are in debt, you need to invest. Despite you being in debt, you need also to invest. You need to set aside a certain percent. You need to pay yourself. Yeah. And one thing that we tell people when it comes to debt, we have sat with many investors and you do even debt restructuring and all that. Sometimes we tell you, whatever, if you have these short-term loans, whether the one that has a higher interest rate, you can clear that first. The one that has maybe the short-term, clear that. And you continue the one, maybe a project and all that. So this is a question that one, we can sit down and we can talk more about this loan and see what other factors that you can consider and how is it affecting maybe your financial level. And then someone has asked what portfolio would work for Muslims. Yeah, that one we've answered. We said we can have one-on-one. Then there's a question. I don't know whether there are other questions. I'm not able.
There's Julius.
Yes.
I'm just after allowing her to be able to ask her questions, I've pushed her to be a panelist. And then after Juliet, you can go to the next person. Juliet, if you're in a position to talk, just unmute. Just unmute.
So I'm seeing a question about someone says to buy or to build. I tend to think it is a home, and I think it will depend. As I said, to buy or build, it will depend on where you are. If you're building within your budget, sometimes building becomes cheaper. You source a land, get somewhere, try to get. There is a lot of work that will be involved because you've been involved in the process and materials and all that. So if you have that and maybe you don't have enough money to say, I complete this house and occupy and all that, you can do it in stages. First of all, acquire land and move it. If you have enough money and different priorities, but it will depend. If you're taking a loan and where you are targeting is also higher and the implication on your payslip or whatever it will have a dire impact on you, then I think building will become a cheaper option. Yeah. And also try to source experts advice when it comes to building. And then there's someone who has asked, which is the best investment you can advise for excess income, bonds or money market? Both they are good, bonds and money market. This excess income you have, are you looking, we need to go something I said, goal-based investing. Rather than just you putting money in the money market fund for short term, whereas you have another goal, let's say like an retirement portfolio, we can move this money to bonds or a fixed income fund, whereby it will earn you at a good rate compounding, and have a plan. You can have a plan like this, or go direct buy a bonds and be getting coupons every 6 months, and for the longest period of time. So it will depend, yeah, for the goal that you have, goal-based investing. And this one, I would say, let's have a sit down and address this, maybe try to analyze other options that you have, and also your historical in terms of your investment journey. Money market fund is for short term. So I don't know, Dorcas, whether there are other questions that you're able to read.
I would like to ask a question. Good evening, everyone.
Yes,
we have the insurance policies and the pension plans and the mortgage plans that allow us to have some sort of relief on our payslips. If we go the alternative route, as you're suggesting today, and go through a profile, any that would suit our financial goals, does it impact our payslips in any way? Do we get some sort of relief?
Thank you. Thank you for that question. So one, this fixed income, all these assets, they have a tax. There's a withholding tax, which is a 15% on the interest. And across the board, if you go and buy the bond today or do something else there, you'll find there's a withholding tax. So for us, we may not be able to give a tax relief unless whereby you have a life policy or something like you have mentioned, but also check the growth. What is the growth in terms of your portfolio? If you're able to get a compounding returns of 11.5 or even 12% in your investment, you realize this, you are getting a relief on the other side, but what you are getting, you're not even able to beat inflation. Or what you're getting, and I say this, I know there are good people in the insurance and all that. I say insurance, mainly the purpose of the insurance, and when you check, it is risk mitigation. And then risk mitigation is in case this thing that comes and offset, comes and interfere with your income or your lifestyle, it takes you back to where you are. So sometimes you find these insurance products, most of them, they are for indemnify you to the position that you are. But in terms of investment aspects, you may not gather more, or you may not even have much control. Because as we have a lot of in this side of the investment, give a client more of a control. Apart from you investing in a money market fund, you can come and tell me, I'm building a legacy portfolio. A legacy portfolio will mean, let's open a managed account. What's a managed account? We go to your bank of choice, open a custody account, deposit the funds there, and we buy you securities specific, and we manage this portfolio for the longest period of time. And you give us a target return. We say we'll perform at 14% or you perform at 12%. Then what is we do a lot of risk analysis and tell you, this is security we can buy, this is security we'll do those things for you. So there's a lot of flexibility. And when you're in another, for insurance, I would say use that for protection purposes. It's very important. And also for the investment, use them for the investment, and also do the maths and see what is the impact, the relief I'm getting and the growth on my portfolio. So that's the thing that you can assess. But we can sit down and also have a discussion on that. Someone has asked about, Juliet has asked about bills or money market fund. What is the return? And the bills you buy, yes, the bills you buy for short term, let's say 90 days or 364 days, 182 and 364 days, they trade in what we call a discounted model, whereby if you buy it if it's 100 shillings and it's maybe the bill is at 9 shillings, you're depositing like 91 and mature at 100%. But in the meantime, what money market funds offers is a flexibility. In the meantime, you'll get a return between 9 to 10%, compounding monthly. The bills on the other side, they give you simple interest, doesn't compound. Money market on this side compounds, and money market gives you a quick way of accessing the money. For the bills, you have to wait for that period of time. So what we are saying is weigh these options, and depending on what we call it, goal-based investing. Why consider the bills and not money market? What is that need you have? Can we go beyond and maybe we realize, in fact, you don't need a money market fund. You need a fixed income fund, which will work for 1 year for you or even 2 years for you. So that's something, Juliet, we can have a discussion on. Don't know whether there is another question. Dorcas, there is another question.
For now, I can't see any other, but
Okay.
Is it Balala had said, I'm not sure if it's a he or she, but I said they want to ask a question. So I've given them permission so they can unmute. You're at liberty to unmute and ask your question.
Thank you. I've already asked my question.
Great, thanks. Then I don't think there is any other. One thing I would say is they will leave their contacts. Ideally, this was an introduction journey for you to understand how to manage your budgets, how to figure out how to spread your money wisely. What I would request, because majority of us are across in terms of Nairobi and other counties, look at what is available for you. Take the tips that Moses and Zachary have shared. Make a call with them. I also want to know from each one, as we send the recording, if you'd like us to share your contacts with Moses and Zachary. I actually came to learn more about Nabo Capital from Christine, who was to be here, Wangeshi, and we have been having the discussion with her. And the goal was, and the goal is for them in the month of February to educate as many people as possible in regards to investing with a purpose, in regards to personal finances, and just understanding the intricacies of getting to a level where you feel, okay, I'm comfortable that I can pay my bills, I can sleep, but I'm not worried too much that I need to keep borrowing a loan. You can survive here and there with the Fuliza and the Mshwari for the goodies and all, but at least you're managing your money well and you're more informed. So we have recorded the session. We will be sharing this hopefully latest by tomorrow morning, but please feel free to talk to Moses or Zachary. I have interacted with their products at a different level. Actually should be like a year or two ago, but my learnings have been the most critical for me. It's more about knowledge rather than just throwing in your money. It's more about understanding what options are available for you, rather than just following the wind with what everyone is doing. So I would say, think about the situation you're in. Do not follow the wind. Do not do what I would want to do. Do not invest on what I want to invest in. Invest on what is best for you. Talk to the experts, let them guide you. And Moses and Zachary, from us to you, thank you very much for gracing the occasion. It was great. It was great having you as the first male speakers, and I need to emphasize on that. But I love the fact you worked as well. I think I feel more confident. There are things I didn't know, and I believe most of the ladies echo the same, even from their questions. Thank you for the great attendance. I can't wait for the next session. I would prefer an in-person, but more in line with other things rather than just the general. So I look forward to many more, and say a big thank you to Christine, and say a big thank you to your CEO. I know he had hoped he would do this session. Unfortunately, because of his schedule and being busy, he wasn't. So thank you, ladies. If any of you are not in Women in HR, I want to give an extension to and Bahati. I can see Angela is there. Angela, if you're in a position to talk, I've elevated you, you should be able to talk. Bahati, I know there's something you need to give an update on. I'm just trying to spot you. Please put your hand up. It will guide me to put you in a position to talk. Angela, are you able to talk?
Yes, hi, good evening. Thank you, Moses. Thank you, Zachary. This has been amazing. I've been listening right from the office all the way home. And I've seen we have done a mistake in my investment. And I was like, oh my God, where was this knowledge like a few years back? But still, it's never too late. And I'm sure many of us are in that boat. We look forward to partnering with you for many more, because I look forward to also listening again to another, like an investment, training, or rather, or what you've done for us. And for all the ladies, women in HR, I'm just so glad that you made time to be here. And it's important for us to work together as women, as ladies, as professional, and even partnering with professional like Nabo. And you're able now to really know that it's an authentic company because of the feedback we are getting and all that. Yeah, thank you so much. Thank you, Dorcas. You are always amazing. Yeah. Hi.
Thank you, Angie. Thank you for the kind words. So just a quick update. We'll be having a session on February 23rd. So this is very different from our monthly free session. So this is the centered leadership training. It's subsidized at 500. There's a reason why it's at that cost, because we don't want to lock anyone. However, you will get a booklet for the session. You will get a booklet that will guide you in understanding more about centered leadership. It has a 5-series sequence, which we will have some in person, and we'll be having visiting guests. So I would urge you, if you haven't registered or you haven't thought about it, please do. It's going to be a really impactful one. But most importantly, it will be a skill that you'll be able to transfer in your workplace, whether you're at a supervisory role or you're aspiring to be. So thank you very much for the evening. I know we have extended beyond time, and apologies for that. Have a great evening, take care, and I'll ensure you get the recording and additional material that we can get from our speakers. Thank you all.